Hey everyone, thanks for checking out this video. My name is Travis Rose. I'm the creator of the Master the Market education that you can find linked below in the description. And this is part 7 of the Day Trading Stocks for Beginners series that I've been doing here on my channel. So if you haven't watched the first 6 parts and you're brand new to the market, I do recommend starting off with those first. But in this one, we're actually going to wrap up this series. And because we covered all of the basics already, such as, the differences between swing trading and day trading, the differences between buying and short selling. We talked about different order types, covered all of the basics of technical analysis like support and resistance. We talked about some of the basics of fundamental analysis, and we covered some trading psychology. I really just want to finish off this series by giving you an actual trading strategy, one that is actually pretty well known and one that has proven success. I know actually a lot of investment firms and hedge funds use this same strategy, probably primarily for large cap stocks, but I personally trade small caps and I've had success with this trading strategy as well. So, anyway, with that being said, let's go ahead and dive into it. And we're going to be talking about what is known as a gap and go strategy. Now, for those of you that follow me on social media, you know that I post a morning watch list just about every single day. And on that list, I have stocks that are gapping up and gapping down. And one of the ways that many people trade stocks gapping up is to look for what is known as a gap and go. And this is really just when a stock gaps up in the morning and then continues to run once the market opens. So obviously, because these are stocks going up, these are going to make better opportunities to go long and buy into them rather than try to short sell and profit from them going down. But on the other side of the spectrum, there is also a gap trading strategy that I've talked about in the past on my channel that allows you to profit from stocks that gap up and then come straight back down at the market open, which of course is going to involve short selling. But in this one, we're going to be looking for the winners. We're going to look for stocks that are going to gap up and continue to run at the open. And the way that we're going to find these stocks with the highest probability of a gap and go is by doing some very basic technical and fundamental analysis. Now, just to really clarify what we're looking for here, on the left side of the chart, you can see that the white dotted line at the bottom down here at 102 is where the stock closed the previous day. And this on the left side of the chart with the gray background is pre-market and after hours trading. And then once the background turns to black here, that's when the market opens for the day. And as you can see, the stock gapped up pretty big this day. And right at the market open, it started to trend down and go lower and lower throughout the remainder of the day. Now, obviously, this would have been a great stock to short sell and profit from it coming back down, but it's not going to be the ideal setup for a gap and go. And if we look over on the right side, this is kind of the goal when we're looking for a gap and go trade. You can see that it closed the previous day at about $2 per share, and this day it opened up at about $4 per share, so it had a huge gap up of about 100%. And at the market open, it kind of traded sideways and actually trended down a little bit. But once it found some support and started to pick back up, you can see that later on throughout the day, it had a huge run all the way up to over $9 per share. So I want to show you some of the things that made this stock a great candidate to become a gap and go trade. And then I'm even going to give you a strategy to use that will help you actually buy into the stock because even if it fits the criteria that tells you it may gap and go, you still, of course, have to time your entry as best as you can to get the best price for your position. So, anyway, with that being said, the first thing that we want to see in order for a stock to be a great candidate for a gap and go is first a good catalyst. And this can be any kind of news or press release released by the company that's going to have a big impact on the company, at least in the short term. And the reason for this is because if there's good news released, that's going to create a lot of demand for that stock. And as we know, a high demand and a low supply is going to cause the prices in the stock to rise. So going back to what we talked about just a moment ago with the ones that we want to avoid, the stocks that are gapping up and then come straight back down, a lot of times if you look into the news and you see what's causing the stock to gap up in the first place, it's going to be a pretty weak piece of news that's not going to have a long-term effect on the company and that realistically is not going to validate such a big gap up in the stock. So you want to make sure the gap up is validated by whatever kind of catalyst was released by the company. And just to give you an idea of what some of those catalysts may be, for example, a strong earnings report with growing revenues, earnings per share, net profits, decreased operating expenses, and so on and so forth. All of those things in an earnings report can be a great sign for the company, which in hand is going to be a great sign for the stock, at least in the near term as well. Another catalyst that can have a big effect on the stock price is positive trial results. So if a company is working on some kind of drug or treatment and they're doing trials to see how effective it is, if they release positive results for that trial, that's going to have a big positive effect on the stock. Some other things are partnerships or even quote unquote trending catalysts. And what I mean by that is, for example, if we take the whole coronavirus situation that we have going on in the world right now, we've seen a lot of catalysts being put out lately by companies that are, for example, making masks to help prevent the spread of the coronavirus. Others are working on vaccines and treatments for the coronavirus. And because that's such a big deal right now and it's such a trending topic and a trending catalyst, any kind of catalyst that has coronavirus in it has potential to have a big gap up and a big run throughout the remainder of the day. And that's going to lead us to the second thing you want to see when you're looking for a gap and go, and that's going to be low float slash low outstanding shares. In other words, this just means that there is a low supply. Stocks with a low float have potential for major intraday runs. And actually, if we take the example that we talked about a few slides ago, over on the right side, the stock SGBX, that stock has a total number of outstanding shares of just 1.17 million shares, which is a very low amount and a very low supply. There's really no set number for what is considered a low float, but really anything under 10 million shares has potential to have a lot of volatility and can end up being a big runner because there is a limited supply, especially if you compare it to other stocks with, for example, multi-billions of shares. But the moral of the story is that the lower number of outstanding shares, the more volatility can be expected in that stock, and the greater potential there's going to be for a big gap up and a big run throughout the day. Now, you also do have to keep in mind that volatility does work both ways. So just because it's spiking up quickly with a low float doesn't necessarily mean that it's going to continue spiking up or hold all of its gains. So you do have to be cautious because you don't want to buy into the top of a low float stock. When it's spiking, you want to make sure that you're timing your entries properly and using proper risk management as always. And again, just to recap the stock SGBX, this is really the ideal gap and go. And you can see over on the right side here, this is the Thinkorswim mobile platform. And you can see that there are 1.17 million shares outstanding. And the way that you get that on the Thinkorswim mobile platform is by simply looking for any stock and then going over and scrolling over to the right one slide, and it's going to have the number of outstanding shares right there. And this should be a pretty similar process regardless of which trading platform you are using. So anyway, the third thing that you want to see when you're looking for stocks with a high probability of a gap and go is that there's no recent offerings and no recent dilution in that stock. So if you don't necessarily know what that means, I highly recommend going back to Day Trading Stocks for Beginners Part 4. And that was the video in this series when I talked about fundamental analysis and I explained how you can spot dilution and offerings in a stock. But to summarize that video, offerings have the potential to drive the stock's price down significantly. And the reason for that is because offerings in their simplest form create a significant increase in the supply of a stock. So if there's not a huge demand for that stock and there's all this extra supply being added into that stock, generally that's going to drive the stock's price down and is really going to limit the potential for these stocks to have a gap and go, even if there is a good catalyst associated with the gap up in the first place. All right, so when you're looking at stocks gapping up, those are the three things you want to see first in order for them to be a potential gap and go. Now that leads us to the question, when do you enter the stock? Because you don't want to just buy into the stock randomly if it does meet those three previous things that we talked about. And that's where something that is known as the opening range breakout is going to come in handy and is going to help us find our entries on these stocks. So the whole idea behind the opening range breakout strategy is that you wait for the chart to build for the first 15 minutes. At least in this video, we're going to focus on the 15-minute opening range breakout, but you can use this for 10 minutes, even 5 minutes, or something longer term like 30 minutes or even an hour. But the idea behind it is that we're going to let the chart form for the first 15 minutes, and we're going to be looking at the 15-minute chart. So after the market opens, once that first 15-minute candle completely forms, it's going to, of course, have a high and it's going to have a low. And you're going to look to use that high as a potential breakout. And depending on the range of the first 15 minutes, you can even use the low of that 15-minute range as your risk level to cut losses if the stock happens to come back down. So just to give you an idea of what this is going to look like, again, sticking with the same example here, SGBX, you can see that we have the first 15-minute candle completely formed up here. And once you wait for that candle to form, you can go ahead and draw your lines to show where the high of that 15 minutes was, and you can draw your line to show where the low was of that 15-minute period. And the idea behind the opening range breakout is to wait for a move above the high of the first 15 minutes. So in this case, you can see it forms that high, and then for a majority of the morning, it seems to trend down, and it never really gets back up to that high until later on in the day. So if you were watching this and you were waiting for that first 15-minute candle breakout, you would probably want to avoid it all the way throughout the morning until it gets back up here near the opening range breakout high. And in this case, once it does break out, it continues to run all the way up to nearly $13 per share later on in the day. So this was a huge example, and there was a ton of money to be made on this opening range breakout. But that's going to lead us kind of to the next thing, which again is managing risk. So like I said, you can always use the low to manage your risk and to cut your losses on the trade. But in this case, if you look at the low is all the way down there at about $4 per share. So since we'd be buying the breakout up near $6 per share, that's going to be a huge range to use to manage your risk in this example. And you don't want to be buying a stock all the way up at 6 if you know that your risk level is all the way down at 4. So another way that you can do this is by looking for closer levels of support to use as your risk level instead of using the low from the first 15-minute candle. And if we take this example here, you can see early on in the morning, the stock spiked up and seemed to form some resistance. And like we talked about earlier on in the series, past levels of resistance can then become levels of support, and vice versa is also true. Past levels of support can then become levels of resistance. So in this case, we have some resistance. Later on, the stock breaks out above that resistance, and you can see that for 3 separate candles here on the 15-minute chart, the stock held perfectly above that past level of resistance. So going forward, you could then use that level of support as a potential level to cut your losses if the stock does come back down. So now instead of risking all the way down to 4, you'd be buying at 6 and your risk would be a little bit closer. In this case, it looks to be about $4.70. You'd be saving yourself 70 cents of potential risk by using this other level of support. Okay, so that's the idea behind the gap and go strategy, and that hopefully gives you an idea of one of the ways that you can look to buy into this strategy. Obviously, the opening range breakout is one of many ways that you can buy into a stock. You can always stick to the basics and just use levels of support or a typical breakout over resistance. It doesn't necessarily have to be an opening range breakout, but I really wanted to go a bit more into the specifics on when you can buy stocks that are gapping up. And an opening range breakout is always a strong sign that a stock still has momentum and can be a big gap and go candidate. So anyway, I hope you enjoyed this video, and I hope you enjoyed the entire series if you watched all the way through. And if you did, thank you for watching. If you missed any parts, they will be linked down below in the description so you can go back and watch those. If you enjoyed, please make sure to give this video a like and subscribe to the channel so you don't miss out on future uploads. Even though this series is over, I do have a lot of other videos planned that I think are going to be very helpful. And as always, if you want to learn step-by-step how to day trade, swing trade, and even long-term invest, as well as get access to our trading chat room with over 1,000 active traders in it, you can find more information on that at my website, Master the Market, which is going to be linked down below as well. But anyway, thanks again for watching. I hope you enjoyed, and good luck with your trading.